Well, the Fed's preferred inflation gauge coming in hotter than expected last month. The core PCE price index ticking up 0.6% in January, was up 4.7% from a year ago. And that, of course, putting pressure on the market today. We had the Dow closing off just over 300 points. So for more on this and where markets are headed, we want to bring in Keith Fitz-Gerald. Fitz-Gerald, a group principal. Keith, it's great to have you back. So certainly the market's not liking what we saw from the PCE index reading earlier today. What do you think this means here for the markets going forward and what the implications are for the Fed?
Well, you know, there's sort of a nuanced layering here. Number one, you've got to simply take a deep breath, because a lot of this kind of selling has nothing to do whatsoever with inflation. It has everything to do with the amount of leverage that's being carried. That's really where the Fed comes into play, because if the Fed wants to raise more aggressively, all of these huge traders that are levered up to their eyeballs are not going to want to carry that because it costs them more money. So they sell. So if that's the case, I think it bodes for pressure into June or so. I think the Fed might have to admit that it's as wrong about rates and labor as it was about transitory. So for me, this is an opportunity. If you got 3 to 5 years out, you take this kind of stuff with a grain of salt, especially on big down days, because that's proof, counterintuitively, that the markets are actually working the way they're supposed to.
Okay, and so for the markets that are trying to get ahead of the Fed, it seems as of right now, they're still very much behind or just not believing what the Fed is saying. So how does that course correct itself in the near term?
You know, that's an interesting one. I don't know that I have the precise answer, but that's a very insightful question. I think right now the markets will correct themselves as investors figure out that their best friends are going to be companies that are still putting up great numbers, that are still got great dividends, that are still moving forward into this market, because those are the kind of plays that you want to go for. So a company like Apple is very different from a company like Carvana. A company like General Mills is very different from a Federal Express. Those are companies that are creating value in tomorrow's world, not the world we used to live in.
So for tomorrow's world, there's a lot of hubbub or brouhaha or whatever speculation around what AI could mean for all of those companies that you mentioned. I'm still trying to figure out how Carvana is going to do it. But at the end of the day, where do you believe that the companies that are able to invest right now in some of those longer term kind of moonshots are going to be able to net out?
Well, I think that the bigger players clearly have the advantage because they have the scope and scale needed to deal with it. So obviously Microsoft is first in the water. I think they've invented a Google killer. There's some challenge there. China is going to come quickly on this. There's going to be some companies out of Europe. But underneath it all, there's going to be a company like AI, which is making GPUs, and you can't have AI without the GPU. So if you keep it really simple, it's time to buy the haystack, not necessarily the needle. Go for NVIDIA.